Thank you for joining us for our monthly webinar series from Local Market Monitor, where we take a closer look at this month's National Economic Outlook, which was written by Local Market Monitor's founder, Ingo Windsor. For those of you that don't know Ingo, he's been analyzing real estate markets for over 30 years and is a graduate of MIT and Boston University. He is not your typical economist and has a knack for taking complex data, extracting what is important, and providing unique insights and tangible guidance on real estate markets. So with that, I bring you Ingo and his insights on the economy.
Thanks very much, Carolyn. Every month, we look at the latest economic data to see what they can tell us about the current state of real estate markets and where those might be headed. Our underlying premise is that you make better investment decisions when you have a better idea of the economic forces that affect supply and demand. This month, I want to show data both for home prices and the growth of jobs. On the surface, they show an economy going at a good pace, no sign of the recession many of us promised this year, and a housing market where home prices have held up very well despite 7% mortgage rates. But under the surface, there is some cause for concern. So let's start with home prices. This chart shows the average change in home prices every quarter compared to the same quarter of the previous year. Although prices in the first quarter of this year did not increase at the high rates of last year, they were still up 8%. While it's true that prices in many parts of the country already peaked last May or July, there are plenty of markets where prices have kept rising. This is especially true in the Southeast, where prices in Charleston, Myrtle Beach, Savannah, Miami, and West Palm Beach are near record highs right now. In West Palm Beach, prices in the first quarter were up 14% from last year. That's pretty much the same situation in Tampa as well. To some extent, these are markets with lots of second homes, but the Florida population also grew rapidly in 2022. Many people actually moved there, and home builders haven't been able to keep up. So it's likely that the price boom there will continue a while longer. Elsewhere, the boom seems very close to an end. Home prices in Austin look pretty much like home prices in Tampa for the last few years, but look what happened in the latest quarter. Prices were up just 1% from last year, and they're already down 8% from the peak last summer. It's the same thing in Boise, with first quarter prices down 2% from last year and down 9% from the peak. Looking at the similarity of these four charts, I have difficulty believing that West Palm Beach and Tampa won't follow the same pattern as Austin and Boise. It's just a question of time. Now let's talk about jobs, which drive the demand for housing. In order to understand the effect of jobs on real estate markets, we want to look at three things. What is the short-term outlook for the economy? What is the sustainable long-term prospect? And what kinds of jobs are being created? By that, I mean, are they high-paying jobs that support home buying or lower-paying jobs that support renting? The short-term outlook for jobs is critical for home prices at this point, with many markets overpriced. Remember that only a small percent of homes are on the market at any one time, so only a slight change in demand from lower job growth can have a big effect on prices. In this chart, we see the recovery of jobs after the COVID recession, then a slowing of the pace of recovery at a 2.7% rate in recent months, and a growth rate this high is normally associated with a very strong economy. But is this real growth or still just pandemic recovery? Is this a short-term boost that will give way to a longer-term growth at a much lower level? We can get some clues by looking more closely at the big sectors driving the current rate of job additions. Restaurants are the easiest to understand. They're adding jobs at a 5% annual rate, 600,000 jobs in the past year. Before COVID, restaurants added jobs at the same rate as population growth, which right now is less than 1% a year. So this high rate of growth won't last. And these are low-paid jobs. The healthcare sector also added about 600,000 jobs in the past year, a 4% annual rate, more than twice as high as before COVID. So this also won't last. A lot of the growth in healthcare is an ambulatory care, doctors' offices, physical therapists, outpatient clinics, places that were closed during the pandemic and that are now rehiring. But the biggest increase is at nursing homes, many of which were ravaged by the pandemic. I think we're seeing a restocking of personnel at nursing homes, which will slow once the positions are filled. These are mainly low-paying jobs, nurses' aides, and clerical positions that were the first to be cut when COVID hit. Another big sector, the business services sector, is one of the most important indicators of growth in the economy. It provides the services that ordinary businesses need, so it adds jobs when new businesses start up and when existing businesses expand. Recovery from the recession was fast in business services, as we see here, but the rate of growth has slowed a bit, with 500,000 new jobs in the past year, a 2.5% annual rate of growth. Before COVID, the rate was less than 2%, so the current rate is likely to slow further. And the dynamics within this sector give us some additional clues about the economy. First, the hiring of architects and engineers is steady at a very high level, possibly because of infrastructure projects and spending. This is very positive for the longer term, and these are well-paying jobs. On the other hand, hiring in computer systems design has slowed rapidly. Before COVID, these jobs were increasing at a 4% annual rate. These are high-paying jobs, which probably boosted home prices in tech-oriented markets like Boise. If businesses are using less computer talent, they're not starting as many new projects. And companies are shedding temporary workers. This usually means that businesses are cutting costs because they expect a slowdown, which often is a self-fulfilling prophecy. My take on what we've looked here is twofold. I think home prices in almost all markets will slide down in the next year, even in Florida, and sharply in some places. And I think that jobs are still in recovery from the pandemic, giving us a false sense of growth, with the longer-term rate of growth well below 2%, and with the risk of a slowdown, even if not a recession, still very high this year. A lot still depends on forces beyond our control, the cost of energy, the war in Ukraine, and politics. That's it. In this time of uncertainty, it's important for real estate professionals to stay on top of the local economic and home price situation. Local Market Monitor provides the data and analysis they need with local market reports and investors' meta-analysis. Thanks very much for following along. This is our National Economic Outlook. I'm Ingo Windsor.